You've heard a little bit about me from Dan. Just to quickly recap, I'm Douglas Brodie. I'm a fund manager and partner at Baillie Gifford. For those of you that know Baillie Gifford, you'll know what we do and what we stand for. So Baillie Gifford, Edinburgh-based investment partnership. We have been long-only investors for many decades and a firm history that goes back over 100 years. What we seek to do is act as business owners, not renters of shares. And I think that's quite a distinctive narrative in what is a complex investment landscape that we all are familiar with. And it's really an ethos that extends from our ownership structure. We are a partnership-owned business. The partners all work in the business. It is our company, and we treat it as such. We think that gives us a cultural advantage of what we do. And doing that from Edinburgh, doing that with that ownership structure, we think these, what some people may call softer factors, are actually very important because getting that sort of setting, the incentives and the alignment right for investment is essential. This is fundamentally a people-driven activity, people coming up with ideas. What excites us at Baillie Gifford is finding really high potential, interesting growth businesses, companies that can grow their sales, their profits, their cash flow over the very long term, possibly in outlandish ways. And the more exciting that growth, the better. And we recruit people who buy into that mindset, who share that sort of intrinsic curiosity to get out there and find these companies. We do that in a way that nurtures those individuals and the ideas that flows from them. And that's a capability and a skill set that we grew in equity investing, but it's one that I think that translates increasingly well to that private area of investing too. The majority of our clients are institutional, so pension funds like the previous speaker, but we also have a very strong franchise in investment trusts, which I'm sure very of you are familiar with. Scottish Mortgage has already been mentioned, Edinburgh Worldwide, the Monks Investment Trust. They are all long-standing Baillie Gifford investment trust products. And that desire to find these high potential growth businesses, it runs deep in everything that we do. And if you think about almost that at its core, that extends very neatly into going down the market cap scale into earlier, younger and smaller businesses. And that's something that we at Baillie Gifford have been doing for a long time, and it very much gels with our investment philosophy. If we can find these businesses, potentially fund them, and in the case of our private equity investments, that very much is funding them, we want to own them and we want to retain them. That in essence is long-term investing. It is actually beautifully simple if you get it right. The team, so we are 8 strong in terms of the global discovery team at Baillie Gifford that I head up. We have about 110 investors at Baillie Gifford, some dedicated sort of unlisted investing. That the product Schiehallion that was referenced earlier was run out of our unlisted team. But many of our investors operate in both listed markets and private markets. We set the team up, the global discovery team, back in about 2010, and we launched our pooled fund product, the Global Discovery OIC product, around that time, and we picked up the Edinburgh Worldwide Investment Trust in 2014. We set the team up to really make smaller company investing more relevant in Baillie Gifford. Basically an idea incubator with high potential businesses that could be owned in dedicated funds like EWIT, but also in time could be owned in other more mainstream strategies. And we like to think genuinely they've got the best jobs in Baillie Gifford, just that freedom to look globally for these ideas, to get out there and meet the most interesting companies is a genuine passion of ours and something that we love doing. Just quickly in terms of the investment philosophy that we work to, and I think this is something that will really get to the crux of why it's worth deploying money lower down the market cap scale, potentially into earlier stage businesses that could be listed, could be private. But I think the gist of this is actually very, very important. Now, As you come down that market cap scale, or as we've seen more companies staying private longer, just that universe that you can invest in is huge. We think in the listed universe, you're probably talking about 30,000 companies. Best attempts to try and scale that sort of the private opportunity set would suggest it's at least as big as the mid-cap market in the US. So it's a very big pond that you are fishing in for ideas. But there is this sort of notion that you have to get your head around that most small businesses are actually not that interesting. That's the slightly dirty secret of small cap investing. So yeah, that's it's an important point, and I think a lot of people that approach this in a very asset class centric way do tend to miss that. But if you set your stall out not to think that this is an asset class problem, but this is something where there is a small subset of interesting businesses out there, and we would describe that as problem-solving businesses. Yes, they're small, but that's by virtue of them being young, by virtue of them being early. But these are the companies out there solving problems, that they are looking to do great things. And as investors, if you can access those businesses early, find them when they're young, let them grow, that in essence is investing. When we set up our products, we deliberately structured them to have no market cap trigger points, either in a sort of listed or unlisted sense. We want to own very large, successful companies, but we seek to do that by buying them when they are small. We think there's a purity to that a lot of the asset management industry does actually miss. You have to be patient at doing this. I mean, this is a very sort of common plea for investing generally, but you have to be patient and genuinely long-term. Part of that is just the simple benefits of compounding that take time to come through, but it's also essential to deal with that uncertainty component that is at times very uncomfortable, but investing, you have to get your head around a tolerance to a degree of uncertainty. Having money at risk magnifies that. It can be quite uncomfortable, and you often see this pattern of when investors become more fearful of uncertainty, the time horizons contract, and the focus is on the short term. But building great businesses, either privately or public, takes time. It takes years, it takes decades, and that progress will not be linear. So as an investor, you have to really have the right temperament to do that. The reason why we have this approach and why we've refined it over the decade that we've been doing it is really the outsized asymmetry of investment returns that can build from it. So I appreciate that there's a lot on this slide, but let me talk you through it. So if you focus on those blue bars in the middle, this is really a cumulative holding period analysis of the Edinburgh Worldwide Investment Trust since I took it on back in 2014. Each blue bar represents the percentage return of a holding in the time that we've owned it. And the uncomfortable reality of investing with that sort of growth mindset is you will get ideas wrong, you will get stocks wrong. There is always 100% downside when that happens. So you get those bars towards the lower end of that plot where you essentially you lose all, if not most, of your money. But if you have no tolerance of that, then you never unlock the real beauty of investing, which is essentially the uncapped returns that are available, certainly in a listed sense with share prices and in time, I think also in private markets as well. And investment asymmetry, I think, is very important and misunderstood by investors. It's really that notion that a handful of stocks will do the bulk of the heavy lifting. In the context of EWIT over this time period, just 6% of our holdings delivered over 50% of the performance. And we expand on those top 10 contributors to that on the left-hand side there. And it's really that sort of notion in what is a comparatively short period of time here. I think we're talking 7-8 years. Just the amount of upside that you can extract from these ideas. But also we've tried to capture there what we call the max drawdown. So these are periods where you have, in your ownership of what ended up being very successful businesses, you've had to deal with periods of turbulence when almost the stock market is sending you a signal that you're getting these businesses wrong. And that I think is, this is dated to end of October. So this is, periods in the past, but essentially I think we're probably in another period like that at the moment. But it's tried and tested to actually back the fundamentals, and the fundamentals prevail over much of the stuff that the stock market can throw at you. If you're interested in finding some of these high potential businesses, well, these are the lessons from us in terms of doing it. Focus on companies that are really out there trying to solve large problems and reshape their industry. The bigger the problem, the better and the more intuitive appeal it is to us. Spend a lot of time understanding the management, the motivations, the credibility, the strategy for doing that growth. People build businesses in the end. You can have a great idea, but if you haven't got the right people in place, then you will not make any real success of doing it. We try and focus a lot on businesses that have a real sort of hints of an emerging edge. And by that, I mean, these are young companies. So we want the ingredients to be in place for a hard competitive edge and differentiation to emerge from those companies in time. And probably the biggest lesson from us is really a great emphasis on companies that have inherent scalability, a real scaling advantage. And that is very, very rare. Most companies hit real diseconomies of scale as they grow. But you are seeing a wave now of sort of digitally powered platform-based businesses that have a real genuine virtuous circle element to how they operate. And the premium that you should be prepared to pay for some of those businesses, I would argue, is very sizable. People tend to associate that most with many of the internet companies and the classic network effects that prevail with that. But the notion of platforms, we're now seeing that in healthcare. It really is sort of extending out that scalability point. In the interest of time, I think I will slightly gloss over this slide because I was keen to focus a little bit more on the private companies side to what we do, given that's a real sort of gist of the discussion today. As you heard, Edinburgh Worldwide and many of the other Baillie Gifford investment trusts are primarily vehicles that invest in listed equities, listed businesses, but many of them have flexibility to invest in unlisted companies, private companies. And if you're thinking about how that opportunity set was described earlier on, we're probably at that interface between sort of venture capital and growth capital. It sometimes looks overly neat when people compartmentalize things like this, but we're not trying to be early stage VC investors in what we do. We are typically investing in companies where the bulk, in that private sense, where the bulk of the technology risk of the company has been navigated, and it's now on that cusp of sort of commercialization, or that's a looming point that's becoming real, or is in that near-term time horizon. As we've heard, investment trusts are a great vehicle for doing this. That closed-ended fixed pool of capital is a genuine differentiator that can feed off the inherent philosophy of an investment trust. At Baillie Gifford, we've really sort of put great emphasis behind this over the last 5, 6, 7 years. We now have over £4 billion worth of clients' money invested in unlisted businesses. I think the majority of that would actually be in investment trusts as the vehicle for doing it, and that's across 70 or so names as currently. We have also many companies that we invested in privately that are now listed as well, so it's a bigger sort of opportunity set. And EWIT's ambitions in this area have moved on quite substantially since I took on the trust in 2014. Much of that's actually been driven by my co-deputy, Luke Ward, who has a real sort of interest in this area and has been behind many of these ideas that have come through. We first made our unlisted investment back in 2015 in a company called Oxford Nanopore, which is recently listed in the London Stock Exchange, and really captures that sort of emphasis behind accessing these really high potential businesses at a stage when typically you wouldn't be able to do that. What does unlisted investing bring to these investment trusts? Well, I would echo the point earlier that you can really access ideas, people, capabilities, areas of technological advancement that are just not accessible in an easy way in the listed sphere. That trend of companies staying private for longer is real. There's lots of reasons behind that. There's a real cost to being a listed business, which I think is probably going up in terms of that distraction focus and the lack of nimbleness that you can have when you are listed. But there's also this element that companies can now scale faster, that they can achieve more as a private company. And we see that very clearly with some of our unlisted investments, probably most obviously with SpaceX, which I'm sure you're all familiar with watching those sort of rocket videos on YouTubes. Just the amount of sort of pioneering activity in some of these companies is really amazing. The process of analyzing a listed business versus a private company to us doesn't feel, as investors, that different. That there's an element of due diligence and legal stuff that sits on top of that. But arguably, that being that good long-term provider of sensible capital, which is so implicit in acting as a private investor in these companies, that is a big differentiator, I think, versus traditional sort of listed investing. Many of the businesses that we've invested in, both in EWIT and in Baillie Gifford on the unlisted side, they are typically inbound requests that have come in from the company. Your credentials as an investor are much more at play when you are investing in these companies. There's lots of people that would love to put money into these businesses, but your credibility and your time frame and your approach as an investor can really set you apart. I'll have to take sort of questions on any of the names in particular, but maybe that's just a sort of general run through on the unlisted side. Maybe just a quick sort of couple of slides just to round out the presentation. This is a real snapshot on Edinburgh Worldwide Investment Trust. Hopefully that's given you sort of a take on why we think it's worth having money applied lower down that market cap scale, extending that opportunity set into private companies, and what you need to make a strategy like that work. And I'd really echo that point around just being long-term in a world that is increasingly very frenetic, and short-term is fundamental to this. And in EWIT, we think we have a portfolio that is unique in its approach, unique in terms of many of the ideas that it can access. And we think you're getting exposure to a host of companies that we genuinely think will be active in reshaping many areas of how the world operates. And I know that can sound a bit grand, but when you actually see what these companies are capable of achieving and what they want to achieve, that really does feel very real. 100+ companies, you can look at that in your own time later on when the slides get distributed. There's lots in the investment trust interim and annual report on that. Maybe just close out finally on this slide, which is a snapshot of the top 10 holdings at the moment, to 2 of those top 10 actually being in the unlisted side of things, SpaceX and PsiQuantum. PsiQuantum is coming up with a very radical form of quantum computing using sort of optics to actually embed quantum capabilities in processes. And on the right-hand side, we have the longer-term performance. You do, as an investor in this area, you need a long-term time horizon for how you approach either the companies that you invest in or the products that you use to access those companies. And I think that the long-term performance speaks to that. In contrast to the previous speaker, we've had a tougher 1-year period as growth around the world has generally derated as people have fretted about inflation and investment interest rates, changing. But fundamentally, the progress that these companies are making is something that terrifically excites us. So at that point, I will wrap up and flip it back to the organisers for questions.